Hi, everyone. Welcome to Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on Tuesday, November 4th, 2025. A few things in the news this week that we want to talk about. One was the Federal Open Market Committee met last week, cut the federal funds rate by 25 basis points. That was basically expected. There were 10 of the 12 FOMC members voting in favor of the cut, and Stephen Myron, not surprisingly, voted for a larger cut, and the president of the Federal Reserve Bank of Kansas City actually voted for no action. He wanted to hold interest rates constant, so the target federal funds rate is now 3.75% to 4%. A few notes to make on the press conference that Powell had. One is that he really indicated that a December rate cut is uncertain, to put it mildly. Increasingly, a lot of people think December rate cut is probably off the table. We'll see. But given inflation numbers, given a lot of other factors that are really showing that monetary policy is not overly loose right now, that might be off the table. The other thing is the Federal Reserve ended so-called quantitative tightening. I know that's kind of a technical matter. I'm going to go into that in a minute. Another thing to note just in the last few weeks is more of the Federal Reserve Bank presidents are becoming hawkish. And that basically means that they think interest rates should remain where they are or maybe even increase a little bit. They're getting concerned about inflation. So this is running counter to the idea that interest rates are going to be coming down significantly. I've said it before, I don't see too many variables that would show that a large rate cut is warranted, but these things change over time. Getting back to quantitative tightening, that's been in the news, and I've probably talked about that before on this show. I'm going to go into it a little bit more again, simply because I think a lot of people are wondering what this means and how this is going to impact credit markets. I think it's more of a technical matter than anything, but this goes back to so-called quantitative easing, which is something that began around the financial crisis. So basically, prior to the financial crisis, the 2008-2009 financial crisis, the way that the Federal Reserve primarily operated monetary policy is the banking system as a whole did not hold excess reserves. Reserves are the amount of deposits that a bank has that they keep on account at the Federal Reserve. They can keep some of it in the form of vault cash, but most of it is on account within the Federal Reserve System. And banks did not earn interest on any excess reserves, so they kept reserves in line with Federal Reserve requirements. So what the Federal Reserve did is it could buy or sell treasury bills from so-called primary dealers, and they could increase the level of reserves in the system. And because there were no excess reserves, the federal funds rate was very sensitive to an increase or decrease in reserves. When the financial crisis happened and the ensuing recession, the Federal Reserve was trying to get longer term interest rates down. They were trying to get mortgage rates down, and they were trying to just overall increase the amount of liquidity in the banking system. So when Ben Bernanke was chair, they started to engage in what's called quantitative easing, which is basically open market operations, just like they did before, but on a much bigger level. And to put it into perspective, the Fed's balance sheet, meaning the amount of assets that the Fed held, was a little under 900 billion going into the financial crisis. It exploded well into the trillions. I think the Fed's balance sheet about quadrupled for a while. And then in the mid 2000s or so, they began to taper, meaning that they were reducing the amount of purchases that they were making, and then they were letting the balance sheet run off So they were letting securities that were maturing just mature without replacing them, and this shrunk the balance sheet. So with quantitative easing, I should note that they were buying longer term treasuries and they were buying mortgage securities. Those were the two primary types of assets that they were buying with quantitative easing. Then the pandemic hits. When the pandemic hits, the Fed engages in another massive several rounds of quantitative easing. The balance sheet ballooned up. I think it reached a high of about 9 trillion in 2021. And then when inflation starts to hit, not only does the Federal Reserve try to tighten monetary conditions with higher interest rates, which they began doing in 2022, but they also started to shrink the balance sheet, or what they called balance sheet runoff. And what that meant is that as these securities would mature, they would not replace them. So the balance sheet, the Fed's balance sheet, the assets that it owns, has gone from about 9 trillion. I think it's about 6.5 trillion today. So what the Fed has said is that they're no longer going to engage in this balance sheet runoff, or what's called quantitative tightening. Again, it's all a technical matter. It doesn't have a huge impact. It does have some impact in money markets or short-term lending markets. But come December 1st, as securities mature, they're going to start buying securities to replace what's there. And this is one of the real changes since the financial crisis, is they no longer rely on these open market operations. They primarily rely on interest on reserves. And this is how they keep these excess reserves in the banking system, is that they can manipulate this interest rate. And that's kind of how they handle things since the financial crisis. So it's a very different kind of monetary system, but the Federal Reserve still targets the federal funds rate. So in that sense, it hasn't changed. But that's what quantitative tightening is. It simply means that they were allowing securities to mature without replacing them. Now they're going to start in December replacing those securities, and that would probably ease money market conditions up a little bit. Again, it doesn't have a huge impact. What matters for, I'd say, most credit investors and equity investors is what happens with medium-term rates. Notice the Treasury bill, the 10-year Treasury note is well over 4% now. Since I think earlier in October it reached under 4%. So that's really the rate that I would pay the most attention to. But in any event, quantitative tightening is going to end on December 1st, and that's something that Powell has announced in the press conference after the FOMC meeting. Okay, so another thing that I want to talk about, I want to talk a little bit about an article that was in the Financial Times, which was great, and it's something that I want to talk about in the last few videos that we did. There's an article titled "Big Tech's Market Dominance is Becoming More Extreme," and last week, Nvidia, Apple in recent weeks, and Microsoft. Nvidia passed 5 trillion in market cap. Microsoft passed 4 trillion. Apple passed 4 trillion. So we've seen these big tech companies become even bigger. And what this article is pointing out, I'm probably going to write a blog post on this on our website, fundamentalinvestinginstitute.com. But I want to write a blog post as to how, and this isn't new, but big tech is becoming a larger driver of gains in various stock indices, especially the S&P 500. And so it raises a couple of questions. One is, how good is the S&P 500 as a barometer of the broader economy? And I would say this is not necessarily new, but I would say with the predominance of big tech, the S&P is not a great barometer of the broader market, and it's not a great barometer of the broader economy. When you buy the S&P 500, you're buying a lot of exposure to these big tech companies. There's a couple of things highlighted in the article. One is 8 of the biggest stocks in the S&P 500 are tech stocks. And since the market bottomed in April, around the time of the Liberation Day tariffs, when We had a big sell-off. So since that April bottom, these 8 stocks account for 60% of the gains in the index. So we're really seeing a huge amount of tech concentration. A lot of that is now tied to AI and AI expectations. Those 8 stocks are accounting for 80% of the S&P's net income growth. So the growth in profits for the year, 80% of it's coming from those 8 stocks. If you look at the MSCI All World Index, which is over 2,000 stocks, I think it's over 40 different countries. It's a global index, but even that index, 25% of the value of that index is derived from 8 US tech companies. Okay, and so as this becomes more and more driven by AI optimism, we just have to know how concentrated we are when we own these various indices, because this is a popular investment strategy of just kind of owning something that tracks the S&P 500 or one of the other major indices. So I'll go into detail about that on our blog this week, but it's an important thing to point out. There was a pullback this week on Meta shares, which was kind of interesting. I think over a 5-day trading period, it was down 13-14%. I haven't seen if there's been much of a recovery. Checked the closing price yesterday, but not since then. And there's a lot of talk about investors becoming more discriminant about looking at AI, massive AI capex. And I think it's important to try to separate. There was a good piece on this point where we have to kind of try to separate how much demand is in the pipeline. So AI's, so Microsoft's capex, for example, AI-driven capex is going to be very different than Meta's. And some of it is very speculative. In the case of Microsoft, there's a lot of demand in the pipeline. There's a lot of revenue already lined up. There's a lot of demand for the capacity, whereas some of the other AI companies are much more speculative, and it's important for investors to try to separate those two things. We're also seeing more of this capex going into debt markets, so that's something that I've touched on in previous videos, but it's something that we need to keep an eye on, because Microsoft and a number of these other companies are absolute cash cows, but the AI expenditures are enormous. And despite all of the cash that these companies are generating, AI expenditures are still exceeding that. Another thing to keep in mind is, as AI expenditures are eating up all of these companies' free cash flows, they're not going to be able to buy back stock the way they have in past years. So if that's something that investors were looking at, it's something to keep in mind. Those share buybacks among a lot of the S&P 500 companies are probably going to be significantly less, simply because of what's happening among these tech companies and how that free cash flow is going to AI expenditures. So it's something to keep in mind. That I know we've been talking about a lot of the same thing week in, week out, but that is what's driving markets right now. There are always defensive companies. I think Barron's had a good article saying how, frankly, a lot of consumer staples and other more defensive companies have been pretty stagnant this year. And as we look at the S&P and other indices and break that down, we can see one of the possibilities is that we just get better valuations on non-tech companies. So it's definitely worth screening for companies that are trading at lower PEs, even if they're seeing much lower earnings growth. That may still be a better source of value than just jumping into these tech companies. But I also know there's always the fear of missing out component in markets. But I've trimmed my exposure to a number of big tech companies, just trying to rebalance things. I still remain very concentrated. So in these videos, I've wanted to profile a new book every week, and preferably something that I'm currently reading. I am on this big project We started a Substack, and we're going to make a number of videos for this project where I'm doing this deep dive into the global economy. So I'm reading a ton of books related to that, and because we're making separate videos, I'm not really going to be talking about new books that I'm reading, but I thought I'd profile some old ones. Warren Buffett, who is 95 years old, is stepping down as the head of Berkshire Hathaway, and I thought that I would profile a number of really good books that are either about him or related to him in some way. I think I may have profiled some of them before. Probably the best place to start is a book that Buffett has said really got him started with value investing. It's The Intelligent Investor by Benjamin Graham. This book came out in the 1940s. I think it was published originally in 1949. This is a relatively recent reprint. It has some commentary from a great financial journalist named Jason Zweig. He has commentary on every chapter, so he kind of brings some of Graham's ideas into more of the modern period. One of the things that Buffett talks about with this book is a particular focus on chapters 8 and chapters 20. Chapters 8, Chapter 8 is on market fluctuations. And something Graham does very famously is he puts forth an analogy called Mr. Market. And he said when you buy stock, you should think about having shares in a private company and being in partnership with someone called Mr. Market. Every day, Mr. Market gives you a price at which he will sell you his shares or buy yours. And while most of the time that price is sensible, sometimes Mr. Market can be a little moody, and he will give you a wildly divergent price from what that business is actually worth, and it's up to you to take advantage of those fluctuations. So Buffett has said that this really impacted his thinking. Of course, Buffett went to go on to study from Graham at Columbia and then work for Graham. Graham ran an investment partnership, so he was enormously influenced by Ben Graham. Chapter 20 is really the key to value investing, what Graham calls margin of safety. And this is the idea of really trying to understand what the company is worth on one hand, and then preferably paying a lot less for it. And that difference gives you what he called the safety margin. It's kind of a concept that comes from engineering. It's just like if you have a bridge that can hold 10,000 pounds, you may not want to drive a 9,500 pound truck over it, right? There's really not enough safety margin there. So this is really the key concept to sound investing is margin of safety, and Graham talks about that in chapter 20. Graham is really the father of all fundamental investing. He was writing during the Great Depression at a time when stocks were still considered to be speculative instruments, and bonds were the only instruments that you could buy for investment purposes. And Graham changed the thinking of a lot of investors, and he died in the 1970s, I believe, but his legacy still lives on through, certainly through Buffett, investors like Monish Pabrai, Seth Klarman, Bill Ackman talks about Graham a lot. So a number of other investors, but this is probably the best place to start. This is written for a general investing audience, whereas Graham's other book that I will profile on another video, the first one called Security Analysis, that was published in 1934. That was a little bit more of a textbook, but this is a great place to start for anyone who's just starting with value investing. The Intelligent Investor, this particular edition is great. I think the original edition is available, but this edition is great. We will end it there. I hope everyone has a great week. Hopefully we have some sane markets this week and calm markets, but we'll see. As always, focus on the fundamentals, and we will see everybody next time. Thank you.